Question 121. Which of the following kinds of contracts must be in writing to comply with the statute of frauds? A. A contract that is to be performed within 1 year. B. A year-long lease. C. A sale of crops. D. A contract that covers a 2-year period. Correct answer is D. A contract that covers a 2-year period. The statute of frauds requires certain contracts to be in writing to be enforceable. A key category is contracts that cannot be performed within 1 year from the date they are made. Since a contract covering a 2-year period, by definition cannot be completed within 1 year, it falls under the statute of frauds and must be in writing. Question 122. Broker Andy represents both seller and buyer in a real estate transaction. Although Andy disclosed this dual agency in a written disclosure form provided to both parties before the sale closed, he did not mention anywhere in the form that the seller was an old college friend. In this situation, Andy is A. Not liable for any wrongful behavior because he notified the parties in writing regarding the dual agency. B. Liable for disciplinary action from the real estate commissioner. C. Not liable if both parties consented in writing to the dual agency. D. Either A or C. Correct answer is B. Liable for disciplinary action from the real estate commissioner. While disclosing dual agency is essential, it's not the only disclosure required. A broker must also disclose any other material facts that might influence the parties' decisions, including any relationship with either the buyer or seller. The fact that the seller was an old college friend is a material fact that should have been disclosed, as it could potentially create a conflict of interest. Failing to disclose this relationship, even with written dual agency consent, is a violation of the broker's fiduciary duties and could lead to disciplinary action. Question 123. A broker from another state refers a buyer to a California broker who procures the sale. According to the real estate law regarding commission splits, the California broker A. Cannot split a commission with an out-of-state broker. B. Can split a commission with an out-of-state broker. C. Can split a commission with an out-of-state broker if the property sells for over $1 million. D. Can split a commission with an out-of-state broker if the California broker has been licensed for over 10 years. Correct answer is B. Can split a commission with an out-of-state broker. California real estate law allows a California broker to share commissions with a broker from another state, as long as the out-of-state broker did not perform any acts in California that would require a California real estate license. The referral is considered a legitimate service, and the commission split is permissible. Question 124. Similar to a trust agreement that secures a loan on real property, A.T. secures a loan on personal property. A. Pledge agreement. B. Security agreement. C. Collateral promise. D. Chattel holder. Correct answer is B. Security agreement. A trust agreement secures a loan on real property. A security agreement performs the same function for personal property, chattel. It creates a security interest in the personal property, allowing the lender to repossess and sell it if the borrower defaults. Question 125. Assignment is when A. One party is completely replaced by another. B. One party transfers its rights and obligations under the contract to another party, but remains secondarily liable. C. A contract is terminated but previous contractual acts are unaffected. D. A contract is terminated and any consideration given is returned. Correct answer is B. One party transfers its rights and obligations under the contract to another party, but remains secondarily liable. In an assignment, one party, the assigner, transfers their rights and duties under a contract to a third party, the assignee. However, the assigner remains secondarily liable if the assignee fails. Question 126. The process of assessing the risk involved in making a mortgage loan is called A. Loan assessment. B. Loan appraisal. C. Loan underwriting. D. Loan applicant estimator. Correct answer is C. Loan underwriting. Loan underwriting is the process lenders use to evaluate the risk of lending money to a borrower. It involves assessing the borrower's creditworthiness, income, assets, and the value of the property being used as collateral. The goal is to determine the likelihood that the borrower will repay the loan. Question 127. Anyone acquiring an ownership interest in real property subject to local taxation must notify the county assessor or recorder by filing the change in ownership form within of the date the sale is recorded? A. 3 days, B. 1 week, C. 1 month, D. None of the above. Correct answer is D. None of the above. In California, when a change in ownership of real property occurs, a preliminary change of ownership report, PCOR, is typically filed. This report provides information to the county assessor for property tax assessment purposes. The PCOR is ideally filed at the time of recording the deed. If the PCOR is not filed at the time of recordation, the property owner has 45 days to respond to a change of ownership statement that the assessor may mail out. If the PCOR is not filed within 45 days, the assessor may mail a change in ownership statement to the new owner, who then has 45 days to return it. A failure to properly notify will incur a penalty. Question 128. The term mortgage warehousing refers to A. Grouping of mortgages sold on the secondary market. B. Collection of mortgages stored in a large commercial structure. C. Mortgages extended to commercial builders. D. Mortgage records kept on paper rather than electronically. Correct answer is A. Grouping of mortgages sold on the secondary market. Mortgage warehousing involves a lender, often a smaller lender or mortgage broker, temporarily holding a group of mortgages before selling them to a larger investor in the secondary mortgage market. This warehousing allows them to accumulate a significant volume of loans, making them more attractive to larger buyers. Question 129. In business, liquidity refers to A. Whether the business can be sold within 90 days, B. Yearly receipts, C. Current assets and current liabilities, D. Bank deposits. Correct answer is C. Current assets and current liabilities. Liquidity in business refers to a company's ability to convert its assets into cash quickly to meet its short-term obligations, current liabilities. This is measured by comparing current assets, assets that can be converted to cash within a year, to current liabilities, debts due within a year. Question 130. If a purchaser with a land contract is paying taxes and insurance premiums into an impound account, those payments cannot be dispersed for a different purpose without the consent of the A. Seller, B. Beneficiary, C. Payer, D. Tax assessor. Correct answer is C. Payer. While the seller retains legal title, the payer, purchaser, is the one making the payments into the impound account specifically for taxes and insurance. Because the payer is the source of the funds and is paying those funds for a specific purpose, they retain the right to dictate how those funds are used. The impound account is, in part, to protect the payer's interest by ensuring that the taxes and insurance for the property are paid. Therefore, the payer has the right to say how those funds are used.